Welcome everybody, my name is Jeremy Johnson with the Indie Investment Group. I want to do a quick update for this week. I want to talk a little bit about how we're making money and losing money at the exact same time, and give an update into why we're even doing real estate to begin with. So this week we got rent checks for the Illinois property. Illinois is cash flowing a little bit. Illinois hasn't had any money really put into it yet because we can't do any work with the tenants in. So right now we're waiting for the tenants to be moving out, which we gave them till spring. Basically, we gave them 90 days, which was more than we needed to give them. But we felt like that was the good thing to do, especially with the holidays and the winter and everything else. But the property is going to lose electricity in order to get that fixed, and a lot of the other things that need to get fixed in it we can't do with tenants inside. So we're going to be moving forward with that. But in the meantime, at least it's occupied, and at least it's cash flowing a little bit, which that's good. So that's a very good, important part of that. So that's what I mean by we are making some money. But we're also losing money. We're starting to lose our working capital. What I mean by that is that when you start off with a certain amount of money, some of the money ends up being just wrapped into the house once you pull out the mortgage. You can only usually refinance some things at 80% and other things at 70%, which means that other 20 to 30% is still wrapped up into the property. You can only get up to 70% of what the house is worth for something like Illinois because it's a multifamily. So when you're pulling out 70%, that means that the other 30% is still wrapped into the property. So all the money is made at the very beginning, and it's because you don't want to run out of working capital. But I do want to explain why we're even messing around with real estate to begin with. There are a lot of videos on this, and I would encourage anyone who's interested to actually watch some of those other videos. But basically, the basic gist of everything is it breaks down into simple ideas into why real estate works and why it works really well for people. One is a number of different ways in which it creates income. There's cash flow, appreciation, and then the mortgage equity. As your tenants pay down the mortgage, you gain equity over time, and as the property sits, by and large, if you take care of a property goes up in value, and so it does appreciate over time. So those three things become what you look at. You want to make sure it's cash flowing, you want to make sure that it's going to be in a place that actually appreciates, and you want to make sure that there's a mortgage equity. If you have all three, then you're in good shape for income. So the other big one is tax advantages. There's a lot of good tax advantages. There's a lot of great books on this as well. Some really good reading for you if you really want to fall asleep, or some reading about tax laws for investment real estate. But the one key thing you get is depreciation, and you get, so the value of a home divided by 27.5 years is depreciation, which comes off of the income that was made. So for instance, if the Illinois property were to be assessed at $100,000, what that means is that the $3,600, 3636, is removed from the income. So Illinois, once it has a mortgage on it, you have about an equity gained of about $2,000 a year. The mortgage going down by about $2,000 a year. Appreciation of maybe $1,000 or $2,000 a year as well. And then you also have that the income, the actual income from Illinois, should be close to about $5,000 a year. So once you have about $5,000 a year that would come off the top, that's how much you made off income. But you get to write off all of the other costs associated with it. So things like repairs, other issues with the property itself become tax write-offs, and you can also increase or also take off the depreciation amount, $3,600. So you're actually not taxed on all of the income; you're only taxed on a little bit. So it's a huge advantage as well. Lastly, you have the ability to leverage, and this is where it gets really interesting into how to do this with real estate. Is that unlike a lot of other asset types, you don't have to put all of your money into a single asset with it whenever you start to leverage your real estate. There's a lot of people who say, well, maybe you should just own your real estate completely free and clear. Well, that's true, and it will increase your cash flow, but you also then won't get some of that equity over time. Not a big deal because you are losing money through the mortgage, but you could take the amount of money that you would gain from putting a mortgage onto it to be able to purchase another property, to then increase your cash flow, to then increase your equity, and then so on and so on. So that's the leverage piece that comes down to, is that you can use amounts of money from the real estate itself to leverage into another property. You don't need the full purchase price. We've done that with cash only because it's been able to help us for closings quicker, but we don't have to do that. We could easily leverage into another property for 20 to 30% down, and that's really where the idea kicks off. I'm going to forget So I want to tell everybody to like or subscribe if any of this stuff helps. I wanted to make this a quick video and just explain why we were doing it and explain how we are losing money and making money. So we are losing money because we're losing our working capital. Our working capital gets wrapped into the properties as we go, and that becomes a little bit of a problem going forward. So how do you start to free up capital? Well, one of the ways that most investors free up capital is they flip. And so you would purchase property for very cheap, and normally what you would want to do is if you would try to hold it. I'm a hold investor, meaning that I try to make my money through the appreciation long term and the rent, because there's a lot of tax benefits to that. A lot of people like to flip though. Problem with flipping is that you have to actively do it. There's no passive income. You have to keep at it, and you have to keep working at it, and you have to keep buying property, fixing property, selling property. So it becomes a little bit more difficult. There's also not as many tax advantages to flipping. The capital gains made from that is taxed at a different rate. So it's a little harder to make your money whenever you're being taxed differently. And there's a lot of different ways that people talk about doing that, between doing it with corporations and other things. And I'll get into that in a different video, because we do have an LLC, but we're also not buying through the LLC. And so there's a whole reason for that, and I'll explain it in a different video. But so we're going to probably have to flip a little bit in order to increase our capital holdings and increase that amount. But the other way you can also do this is bringing in other investors. So that's where a lot of other friends and family come in, is that they're cash heavy, but they're asset poor. We can fix that, because we can bring in and help them out with finding out other assets, and then we can manage to still leverage those and then move into more assets. And that's the idea, is that you can do this in a chain of events. So for instance, we still are going to have roughly $100,000 in working capital once this is all done. So we would have lost about half of our working capital, but we've taken on almost $300,000 in assets. And in those $300,000 in assets, they've only been 70% mortgaged. So you now start to see that this can start to steamroll, and you can hopefully get up to a point in which you have $500,000 in assets or $1 million in assets. Now again, you have debt on top of that, but your assets should outweigh your debt. Now, if we have a major falling out where property values plummet, and let's say that we end up into another major recession, well, how are you going to deal with that? Well, again, rent usually goes down maybe a little bit, but rent usually holds pretty well too. So as long as we're long-term, buy and hold, so as long as we don't try to sell the property, we shouldn't take a loss. We can wait, and we can wait until the market stabilizes again, and then just continue in the meantime to work on that cash flow. So you can lose your appreciation, but you're still gaining equity, and you're still gaining cash flow. So the key idea is to make sure that you're getting all three. There's lots of investors who are in different markets can only do one or the other. Maybe they can only do cash flow because their area is not appreciating very well. For instance, the Illinois property will not appreciate as well as the Warwick property, just because of the areas they're located in. But there's plenty of people who are buying in, say, California or other places where the appreciation is going up very, very quickly, and they can actually stand to take a little bit of a loss every month. There's a lot of investors who don't really suggest that, and I completely agree that I would not suggest taking a loss every month in order to account for appreciation. That to me is almost like betting on the stock market again. We're not trying to do that. These are much more concrete assets, something you can, tangible assets that are guaranteed to kind of do something over time. There's a reason why this is a slow play, it's a slow burn, and why real estate has made more millionaires than any other type of investment. So hope you all have enjoyed this, and happy holidays.